Hi, Summer and Eddie. I'd like to send a short video instead of a long email, so here goes. I enjoyed meeting with you both, and we'd love to work with you. I think you're leaning towards self-directing since you haven't replied to my emails, but I'll give it a shot. Your investments are in good shape. They're okay. They could be better with probably, I think, better returns over time and a lot lower risk. Uh, but the biggest need you have is for financial planning, which we could provide, and we'd love to do that for you. On the screen is me and Susan, my second in command. Also working for us is Stephanie and my son Lennon. Lennon basically handles the website, and this is Stephanie's our operations person. She's studying for Series 66, which is a license that I have, and Susan has the investment advisor, and that means we'll have 3 advisors to handle about 100 clients. Just to review, here is the Schwab website that we use as a custodian. This is the current assets we have under management, 105 million. We have about 4 or 5 million in other custodians with our real estate holdings that aren't custodied here. So we're at about 110, and there's about 95 clients. On the financial planning side, here's a list of 50 things that advisors do. If they're a good advisor, we talked about Roth conversions, your Social Security, college funding, tax management, estate planning. We do all of that. And it's part of our fee, our investment advisor fee. There's 50 things on here, and you can take a look at this. I'll send it to you. I mentioned DFA during our meeting. This is their performance versus the industry. Basically, these are all of the active funds. DFA is active, but it has the fees of a index fund, which is one of the advantages. And this shows that over 1 year, 48% of DFA funds survived and outperformed the other people. And this doesn't include index funds because index funds always underperform. So 100% of index funds are underperform their benchmark. They can't overcome their benchmark because they have fees and the benchmark doesn't. And in addition to fees, an index fund or a target growth fund has spreads and rebalancing costs and other costs that were always and everywhere going to be under a benchmark, which doesn't have any of those costs. So over the longer term, if you go out 20 years, 84% of DFA funds have outperformed other active fund managers and all index fund managers. I did a quick review of Eddie's 457 and 401, and here is a little bit of, I just took kind of a granular look at it. So there's no way to look at the performance because I don't think it's available from the place that the funds are in any kind of robust form. But I just broke it down because into the bonds, you have about 8% in bonds, 92% in stocks. I broke up the 2030 target date because it has both a bond component and a equity component and all the other things you have in there. You're probably very underinvested in international, which should be about 10% of a stock portfolio. And for the last 2 years, international's done much better than US. And this large cap is almost all US. So there's many tweaks to get your bonds and your international, your large cap, fixed income performing better. And that's kind of what we do. This next little section down here. So this was the Roth, $60,000 in the Roth. We talked about you're probably a good candidate for a Roth conversion. And then this is 457 and the 401k, not including the Roth, got mushed together. And this is the assets, the name of the assets, the value of the assets, the type. So in this one, you've got 13% and 87%. Both are very, very aggressive. I don't know enough about you, even your ages and your risk tolerance. You've made the right choice in general. I like it when clients or potential prospects come. The investments are good. They could be a lot better. In many ways, you have way more risk than my clients do. We usually have about 20% less than the benchmark. We're able to hedge during confusing times like right now when there's a lot of volatility and chaos, and prevent a large decline, which has worked during the Iran war and during the tariffs and during COVID and during all the other temporary declines the market had. Okay, now we're going to take a look at performance of a sample client. So this is a real client, been with me over 10 years, but we're looking at the 10-year performance for this client. And the returns are annualized, not cumulative. But you can see his top line, he's made almost $2 million. He's had close to 8% returns, but we're trailing his, what we call a class blended benchmark. So it's very, very difficult to track performance relative to a benchmark. For a client, it's a little easier because I chose this client because he's not the best performing. He's obviously not the worst performing, but he's someone that takes my advice. So we're responsible for the numbers that are on the screen, and he's done very well. He has trailed the benchmark by about 1%. Now, here's where the complexity comes in. He's got real estate. So you guys don't have any real estate. It drags down our performance. We like it because this, in general, over the last 5 years, has produced about 8% returns. He's had something in the early years that distorts that. But over the last 10 years, our real estate's been producing about 8% returns with very, very little volatility. So on his equities, he's actually outperforming on a 10-year basis, on an annualized basis, very close on this little, well, he had a little balance fund in there, so we'll ignore that. But the other big one is fixed income. We're actually outperforming in fixed income. This is money markets. He's got a little bit in cash. This is where most of the underperformance, in addition to our fee, which for this client is around 1% because it's a very large account, he's lost about $124,000 over the 10-year period, which is about 1% per year. And that's causing most of the drag. If we had not hedged, now this client loves the fact, he's recently retired, loves the fact that he cannot lose in a sudden steep decline more than 10% of his assets. In general, we're making market level or benchmark level gains with a fraction of the risk of an unhedged portfolio. This is what's called standard deviation. It's basically how much risk do you have. We have 0.9% or 9% versus almost 11%. It's almost 20% lower, less risk. If you looked at a graph of one versus the other, we might go up slower, but we go down much, much slower. In general, we outperform by a lot in a down market. Finally, I'm just going to review what I showed you during the meeting, which is our financial planning software. It's called eMoney. This is a real client with a fake name, and this is the landing page. This shows you that we can do an enormous number of goals and plans. We can make lots and lots of scenarios. These are examples that we did for this client. There's a million things you can do: buy a house, sell a house, retire early, etc., etc. There's virtually an enormous number of reports that we can generate for you. The favorite reports are the cash flow, retirement cash flow, that shows you year by year. I'll take a look at this client's cash flow. This client is almost achieved their retirement goals. I don't think the people behind this are retired yet, but currently they're showing, based on all the assumptions, we have their income, we have their expenses. Their incomes from all sources. Expenses include taxes, everything that's got to do with expenses. And over time, they're contributing. But when they retire, and it looks like they retire in a few years, they start usually using some of their assets. And this looks like they could draw down their liquid assets, not their real estate assets, but their liquid assets, and get all the way up to 93. We usually run this for most people at age 90, but we ran it for 100. So it actually works all the way until they're 90. And then, of course, every year before they retire and after retire, we try to make this plan look better. We try to do the things that will increase the odds that they'll be successful. So I'm going to leave it there. I hope this is helpful. I'm around all the time. You've got my contact info, so give me a call if you'd like to talk. Alrighty, bye-bye.